The Bank of England have slowly been raising interest rates. In fact, they've just done the 6th consecutive increase. As property investors, we want to know where they're going to go with these increases and what does it mean for the property market. If you're watching my videos for the first time, my name is Saj Hussain, and on this channel, I share with you my 15 plus years of property investing experience to ultimately help you get further faster in your own property investing business. Interest rates right now, they stand at 1.75%. We've just had the biggest single increase of 0.5%, which hasn't happened for a very long time. The Bank of England recently started increasing interest rates. I think the first increase was really more psychological to say, hey, look, be aware, the market's now changing, we're going to start increasing these rates. But nobody was really sure where these rates are going to go to. The Bank of England Monetary Policy Committee meet every 6 weeks and the members then vote what to do with interest rates. There will be 3 more of these meetings before the end of the year, and the signs are already there that the rates are going to continue to increase. In fact, they've already said that the normal rates are probably going to be around 3 to 4% by the end of next year. That's more than twice what they are right now. So why is it now that the Bank of England have chosen to start increasing interest rates? Well, it's the main tool that they would use to control inflation. And ideally, they want inflation to run around 2%, and it's currently at 9.4%, which are the official figures, but it's probably significantly higher than that right now. But it's also expected to continue to increase and hit maybe 13% before the end of the year. The purpose of increasing interest rates means our costs start increasing in terms of our everyday expenditure. It's just more expensive to do things. So what that means is that we end up with less money in our pocket and we spend less money, so the economy slows down. Inflation is currently being driven by the increase in fuel and energy prices. However, we also need to remember that in this country we printed £895 billion of currency between 2009 and 2021. This increase in currency then also causes inflation. When we look at historic data and pre the financial recession, what we find is interest rates typically were significantly higher than they are right now. They were reduced at the time during the financial crisis to try and bring the economy under control. And they've stayed very low for about a decade. So even now, the rates at 1.75 is still very, very low. The prediction of it reaching 3 to maybe 4% next year is based on inflation getting under control and getting back under 2%. But the reality is the chance of inflation dropping from where it is right now, the potentially 13% before the end of this year, right down to 2% before the end of next year, is very unlikely. So interest rates could rise even further. What these rates translate to ordinary individuals means that their mortgage costs are higher. But many people are on fixed mortgage rates. About 82% of people have their mortgages fixed for a period of time, 3 years, 5 years, whatever that period of time is, so their rates won't change. It's only when they come off those rates and go on to what's called the standard variable rate, it's likely those rates will be much, much higher than they were at the time when they fixed their mortgages. The remaining group that have variable mortgages, whose mortgages are not fixed, their interest payments on their mortgages will increase immediately. And each increase in the Bank of England base rate marks an increase in their monthly mortgage payment. What this means for the property market is that the market will start to slow, it will cool off. So houses will take a little bit longer to sell, prices won't continue to rise, in fact they might flatten off, but it's unlikely based on what we can see right now that there'll be a crash in the market. However, as the market starts to slow, this will present massive new opportunities for property investors. There'll be fewer people chasing those same properties, meaning that you can negotiate better deals, and there'll be more motivated sellers in the marketplace, people that are keen to do a deal, meaning that you've got more opportunities than you'll have faced maybe in the last couple of years. Landlords with mortgages will also start to feel the pinch in terms of their profitability being squeezed. However, one saviour there is the rents have also been starting to increase and increasing significantly. But as the financial pressures start to bite all round, you will start finding more people in financial difficulty. People need to sell their property, repossession levels will start to increase, and there will also be some landlords who will make a decision that enough is enough, it's no longer viable to be in business like the way it was for them previously, especially with the impact of Section 24 and the tax changes that's had on them. So what is it that you should be doing right now? Well, firstly, it's being aware that there's changes happening in the marketplace. So if you're looking for deals, you'll start seeing more opportunities. And if you're an existing landlord and a property owner right now, it's important that you review your figures and stress test them to ensure that it's still viable with an increase in interest rates. And I would stress test at 6, 7 and 8%. So that way, you know, if the rates do increase and they increase significantly, where will that leave you? What that means is that you're doing modeling on your figures, that if your interest rates were much higher on your mortgage versus what the current rents are, where would that leave you profit margin wise, or would that put you in a negative situation? Because by being aware of that, you can make decisions of what it is that might be the right thing for you to do next. For some people, it might be they want to sell property. Other people might be they want to transfer their mortgage to a different product, to a better deal. Maybe they want to fix them for a period of time. And others may want to reduce the amount of borrowing they have, i.e. reduce the loan to value to put them in a slightly more comfortable position. You should also be considering the income side. So if you're about to start in your property investing journey, look at those high cash flow strategies, HMO, service accommodation, that bring in significantly more income. And if you're an existing landlord, maybe you want to review your rents to make sure you're getting market rents, because rents have gone up significantly the last year, and there'll be many people that'll be effectively charging lower than a market rent right now. And it may even be that you consider switching to a different strategy rather than letting to families. Maybe you want to convert the property to HMO, or maybe even service accommodation, again bringing in significantly more income. Whatever it is that you choose to do, the important thing is that you're aware that change is coming and that you should be ready. And if you've enjoyed this video, then do me a favor, click on my face over here to subscribe to the channel, and then click over here to watch this video to show you how to find deals in the market that we are in right now that's constantly evolving.